Good day, John. Good to see you this morning. We're recording this on Thursday afternoon, and it's good to see lots of green on the share market today, John. The market's up about 70 points, and I think we're less than 100 off the all-time high, which occurred, I think, earlier this month. John, the latest economic data point to come out in Australia is the labour figures. The jobs market grew to a surprisingly strong level, and unemployment's fallen from 4.1 to 3.7, and that's taken the market a little bit by surprise. What do you make of it all?
Well, I think it's going to take the government by surprise, Paul, because they've been trying to talk the budget down in terms of receipts. So if we're employing 100,000 more people, say in February, then a lot more people are paying income tax, and it's going to go into the government coffers, as is the fact that those people are earning wages and consuming, and they're buying goods and services, paying more GST and demanding more from the corporate sector. So they're good numbers for economic growth. And we have to remember that the recent ABS numbers were quite poor in terms of economic growth and activity, and the fact that the Australian economy was growing at a slower rate than its population. So I think they're quite encouraging numbers. As we've been saying, the benefits of population growth through immigration were going to force their way through. We thought more towards the end of this year, 2025, but maybe they're already appearing.
Yeah, so I think we took in a record number of something like 600,000 new migrants last year, which is an all-time record. And I think population's now up to about 26.8 million. So we'll be knocking on the 27 million very shortly. So when the labour force numbers came out, the Australian dollar immediately went up quite a bit. And the way I interpret that is that the chances are that the Reserve Bank will stay their hand on cutting rates anytime soon. So it means rates higher for longer. And the share market drifted down initially, but has since surged back up. Do you think that rate rises are off the table?
Absolutely. I mean, so I keep on saying in my presentations that Australia will follow America, and the US Federal Reserve overnight had a similar story to our Reserve Bank. They noted continuing improvement in employment in America, like we're seeing in Australia. And the trend, clearly, I think from the Fed commentary that interest rates have peaked in America, it's only a matter of time before they come down, probably when they get certainty around inflation. In Australia, we've got 1% higher inflation than America, but I think we will pick up that 1% fairly quickly in the next 6 months. So I think our inflation rates will be matching with our lower interest rates. I'd say that Aussie dollar jump is just a knee-jerk reaction. Maybe traders are saying there'll be an interest rate cut in America before there will be one in Australia, so maybe that puts a little upward pressure on the Aussie dollar. Based on recent trading of the Aussie dollar, it'll dissipate fairly quickly, and we're back to mid-65s again, because, as I keep on saying, there's relentless selling of the Aussie dollar from our industry funds who are, getting flows, regulated, legislated flows into their funds, and they can't invest in Australia, so they constantly sell the Aussie dollar and invest offshore. So I think it's all short-term trading. I'd like to see the Aussie dollar stronger. It'd be good for our inflation numbers, but at this stage, we've got relentless selling.
What I found most interesting from Powell's testimony and press conference is that it seems like the Fed is now forecasting, according to their dot plots, 3 rate cuts, taking the official cash rate, overnight Fed funds rate, from 5.5 down to 4.75, commencing in June or July. But what was fascinating was that they upgraded their forecast of GDP growth in the United States from 1.4, I think it was previously, to 2.1. So the US is really humming along, and that's got to be good for the world economy.
Yeah, I saw that, and they're sort of forecasting 2% out going out 2 and 3 years. So they're looking for a stabilisation of growth at 2%. You could say historically that's below their long-term trend, but it's encouraging given, that the forecast by a lot of commentators was for a recession, and still a lot of people out there looking for a recession, which doesn't appear to be going to happen. I just listened to Powell's press conference. He did suggest that their target is still 2% inflation. The recent numbers, January and February, are a little bit points for concern because we seem to have stalled around the 3.25% level. Although he said underlying inflation is much lower than what we're seeing headline numbers in some aspects of the economy, particularly in energy related. The issue is around food costs and the cost of rent. They're issues in America, just as they are in Australia. So what I'm seeing in terms of commentary and the economics of both America and Australia, they're coming very much into line, which begs the point, is the American interest rates at 5.5 too high, or our interest rates at 4.3 too low? I suspect it's a bit of both, but I don't think Australian interest rates are going to go up, Paul. I think they're going to be at this level for maybe at least 6 months. And I don't really see substantial cuts in Australian interest rates until America cuts its interest rates somewhere towards where we are sitting at present, given that the two economies are operating pretty much the same growth and inflation level.
Interestingly, the US markets ended the day at all-time highs. So the S&P 500 closed at a record high, the Nasdaq's closed at a record high, and yes, it's driven to some extent by the mega tech companies, but a lot of other companies are also reaching all-time highs. In fact, something like 100 of the S&P 500 companies are, at or very, very close to all-time highs. So it's spreading around, and it's broadening the rally. Are you starting to feel that it's a bit frothy, or we can relax and be confident that the path looks pretty good?
Well, my belief is that whilst bonds are an attractive asset, I think the yields are going to come down in the bond market following inflation lower. I do think inflation readings around the world, and I did get this from the Fed, that they believe inflation is going to come down. They just can't predict when it's going to be. But if we put a 2 in front of inflation, whether it's, say, midpoint 2.5, and I think that's where we're going to be in Australia, that suggests the bond market's going to pull, the yields are going to come down somewhat, probably let's say 3.5 for 5 and 10-year bonds. And low 2.5% inflation, 3.5% bonds is good for the equity market. Question is, as you're saying, are the PEs of some parts of the market excessive? Well, we can see, based on the rule of 20, and that there does look to be some excesses in the American market and small aspects of the Australian market. But we also are seeing those stocks, which are on high PEs, they're growing at a great clip. Yeah. And when I look at PEG ratios, when you start comparing growth to the PE, and we're seeing, stocks with PEs of over 20, but they're growing at 20%. Yeah, that sort of gives you some satisfaction that the market is okay across it. So, and I keep on saying Australia is looking at quite a good economic growth outlook for 2025. We've got a stimulation in the budget coming. We've got tax cuts coming. The undervalued Aussie dollar continues to drag in tourists. And that population growth, which you mentioned earlier, that'll start moving through the economy more profoundly in 2025. So the Australian economy looks sound, which means the Australian stock market's going to get tailwinds in terms of earnings growth. So I'm relaxed.
Yeah, that's good to hear. More historic news from overseas, this time from Japan. The Bank of Japan was the first to introduce negative interest rates back in, I think it was 2007. So it's about 16 or 17 years ago. And they've finally reversed that. So they've gone from a target rate of minus 0.1 to a target rate of plus 0.1. Do you see this as a sort of a historic turning point? It's no longer necessary. They no longer worry too much about deflation. There's some inflation in the Japanese system. And in fact, the economy is doing quite well with the Nikkei 225 at an all-time record high as well.
Well, look, the Japanese central bank, it's hard to work out who's on more drugs, them or their bond market. But, negative 0.1 to 0 to 0.1 is not going to rock the boat. The interesting commentary, though, I picked up, Paul, was 2 points. One is that they're going to continue with QE at the rate of about 50 billion a month, US dollars. So they're not giving up on buying their bonds. Their 10-year bond is settled around 0.7, 0.8%. So their yield curve is going to go from 0.1 to 0.8 over 10 years. So there's still quite a lot of yield management. But they did also make another commentary that the central bank, which is being active, I don't think this is well reported, but they're being active in the ETF market for the equity and property securities. So they're being quite active in stimulating markets wherever, but they are saying they're going to stop buying ETFs. And I suspect they've made a fortune buying exchange-traded funds or index futures on the Japanese stock market. I mean, I'd hate to think so. Maybe they'll be able to pay back some of the debt for the share trading activities which have come their way in the last 2 years, share market profits. So I think I just took that as interesting that they're going to pull out of pushing up markets. The wealth effect of the equity market, and I guess property markets, is flowing through to the Japanese consumer. So the monetary stimulation right across the economy and across financial markets has worked, and they haven't got inflation. So again, I keep on saying we have to note what's going on in Japan. We have to note that inflation has not stirred up. And it's quite scary for economists to see how much money is being printed, how much stimulation has been put into that economy against the demographic headwinds, the ageing population. So they are battling significant demographic headwinds, but they've held the Japanese economy together, and they come out the other side. It might have taken 20 years, as you say, Paul, but they're coming out the other side, and they haven't got mega inflation, and the economy hasn't collapsed.
Yeah.
So,
in fact,
we watch and wonder.
Yeah, the Japanese economy is the third largest in the world, and their stock market's gone up 45% in the last 12 months. So it's been an absolutely stellar performer.
I think the other thing, there was some wag this morning, and I call him a wag. It was a serious economist. I said, this movement in cash rates may stimulate Japan to withdraw money from Australia and go back to Japan. I had to laugh at that one. I mean, the difference in the bond is about 3.5%. I mean, and moving at 0.1, honestly. But this is what people say and stir up a bit of emotion, but it's nonsense. There is still a lot of stimulation going on in Japan, manipulation of their yields, still printing of money, and that money will find a home coming the other way to Australia, because why wouldn't it? The yield cover. Once the equity market slows in Japan, which it probably will now that the central bank is not buying the ETFs or the index funds, I mean, there probably will be money flowing the other way to Australia. And our interest rates are still very attractive, and our credit rating at AAA suggests that we'll still have more Japanese capital coming this way rather than the other way.
And perhaps that's one of the reasons why the yen weakened on the result. But John, maybe there's more evidence of Chinese money and capital being withdrawn from Australia, because a lot of their property-related wealth is dissipating. So I've seen some reports that some Chinese investors in Australia are repatriating money back to China to shore up their balance sheets. So you hearing anything about that, and you think that would be a credible kind of report?
What's possible? I don't have any real insights. I mean, we have to watch capital flows, and assuming that a lot of the extreme wealth of China, which is invest in Australia, as opposed to just the average wealth. But if there's, well-informed wealth, insider wealth, and if we do perceive that they're moving money out of Australia, that would go against the view, which is being also circulated, that China is looking at a devaluation this year to sustain its economic activity. So you won't be bringing money back to China if you think there's a devaluation. So if what you say is correct, and I have no insight, then that would suggest that there is not going to be a devaluation. So we have to watch these capital flows, and we have to watch these informed capital flows. My view is I'd like to see capital constantly flowing from China into Australia, because that gives me some confidence in the stability of the relationship between the two countries. If it starts flowing out, you have to have a concern.
John, in the meantime, there is some strength in some of the commodity markets, particularly oil, which may be fed by geopolitical factors, but also in copper. Copper, the stockpiles seem to have reduced, and copper price seems quite strong. Any views on commodity markets?
Well, Paul, there's no better indicator of industrial activity since I've been working over 40 years than the copper price. Now the copper price has lurched above $4. I mean, that's getting to historic highs. And I'd suggest maybe the focus, we're too focused on China and not so much on the activity in India. So I suspect the astronomical growth we're seeing in India, Paul, and we're seeing in the last quarter 8% growth, there'd be real industrial investment going on and industrial development. So I think copper may be being driven. Yes, there are supply issues we know about. Good news for BHP, but I think the demand coming out of India and possibly even Indonesia, we know Indonesia is moving its capital city. There are aspects to the developing world which suggest that the copper rally suggests international economic growth is in a good shape.
Yeah, I'll just mention that our investment team have been looking very closely at some of these smaller resource companies which are pretty underpriced on fundamentals. So they're seeing lots of opportunities there, and I think they've been pretty busy in that sector. John, I think we'll have to leave it there. We've kind of run out of time, but always interesting. Thank you so much, and we'll see everyone next week.
Yep. See you next week for the Easter Bunny.
Thanks, John.
See ya.